Hello, everyone. Welcome back to yet another installment of our Lunch and Learn webinar series. I'm your host, Mayur Thaker, and this is an update to the original presentation I gave back in June, just about 3 months ago, on the high levels of inflation that we have been seeing, conveyed by the CPI index and other inflation gauges as well. So this is a sort of an update as to what has happened over the past 3 months since that first presentation I did. And if you do want to check that out, if you haven't seen that just yet, I do recommend watching that video. It's on our YouTube channel, as you can see here. If you go to youtube.com/c/ZacksPro. This is our YouTube channel, and you can see all of our videos that we publish, including the ones done by our managing director, Tim Nyland, and all of the other training videos that we've done, as well as all of our previous Lunch and Learn webinars that I've done. And here's that one right here. It's called The Great Inflation Debate. It's still very relevant because some of the ideas that I kind of conveyed in there, which we'll also do a quick review of today, are still very much relevant. But like we all should do in this business, I'm going to hold myself, accountable to, what things I said in that webinar, and let's see how accurate they turned out to be. So just a little bit of housekeeping. I just wanted to put up this disclosure right here, right before we begin. And as we go along this presentation, if you do have any questions, please do enter them into the GoToMeeting dashboard, the GoToWebinar dashboard. There should be a section there for questions that you can enter in. And as you think of a question, please do enter it throughout the entire duration of this call. And at the very end, I will take a few minutes to address any of those questions. And again, these slides will be available as well. So please do email us, and I will get to that at the very end of the call as well. So the first back in June when we had this call, I kind of gave these key pointers or these key tips of what I think is driving inflation. And I try to define what inflation is very broadly, like why do prices rise and fall in general. And in my view, it's based on the classic interaction, this epic tug of war between supply and demand, right? And it's really that simple. When demand rises above supply, prices rise. But also, even if demand remains constant, prices can still rise if the supply curve drops below from where it was before. And that's kind of the theme that I've been seeing from the original webinar, and even now with all the updates that we've seen over the past 3 months, I still believe that is still the case, and we're going to take a look at that a little bit as well. The other reason that could cause inflation is demand rising, right? But there has to be a reason for that, right? Either demand rises because of true economic growth, where consumers are more enabled with greater purchasing power, and therefore demand is rising faster than supply. That would be a good source of demand, a good source of inflation, if you will. But demand can also rise if there is excess liquidity in the economy. And that's kind of the area where most people are very, very afraid of because of what the Federal Reserve has done over the past year and a half in response to the COVID crisis, where money supply has really, soared. And that's done because of Fed purchases. In addition to the balance sheet, we've seen the Fed balance sheet, explode higher with, asset purchases. And some would call that debt monetization. I tend to agree with that as well. So that is causing, concerns that a shift up in demand is attributable to excess liquidity being created by the Fed. And that's a much harder problem to solve because, it's not that easy to just ratchet up supply, to ratchet up production to meet that increasing demand that is caused artificially by increasing the money supply all throughout the system. So those are the key factors that we have to take into account. And I think that's what we have to look at and find out, what is the source of this inflation? Is it truly due to, demand rising for fundamental reasons? Or is it demand rising due to excess and artificial liquidity created by the Fed? Or is it due to one or two, both of those, in addition to supply being constrained? So there's all three of those factors that we have to kind of think about. And I predicted back in June that these supply constraints wouldn't last more than a few quarters. And I still think the first part of my, prediction, or my sort of framing of what inflation is caused by, is right. But the second part is mostly wrong. And we're going to see a little bit about that. I was definitely wrong about this lasting more than just a few quarters. I think based on the data and updates that we've seen since June, it looks like, to me, inflation will persist for longer. But again, the key question here is the why, right? Why are we seeing inflation remaining at elevated levels? And let's take a look at this next slide here. This, in my view, is one of the keys to inflation. Here I have in this 3-panel chart, which you can create in ZRS as well as in Advisor Tools, is a mix of the ISM manufacturing backlog and overlay that with the CPI. As you can see, we all know the CPI year over year has, surged to about 5.4%, which is really the highest reading that we've seen, dating all the way back to 2007, right before the great financial crisis. And before that, we really have to go way back to see inflation, year over year growth this high, really dating back to the 80s. So it's definitely high. We all know that. But you can see here that, a lot of that is attributable to this backlog, right? Why does backlog grow? Backlog grows when orders are outpacing production, right? And we can see that at the bottom of this chart, inventories are now at really all-time lows here. We haven't seen inventories this low for manufacturing and industrial companies, in the last 25 years. So this is, again, attributable to the fact that there are increasing demand for industrial goods, but an inability for manufacturers to meet that elevated demand. And that's why we see backlog at very, very high levels right now. So I think that as long as backlog remains elevated, we're going to see the headline CPI numbers remain elevated. And I thought that if you can see it here, if you zoom in at the very, end of that high that we saw was right around June, which is when we had this first webinar. And I started to see that, okay, that backlog is starting to come down a little bit. You can see that little bit of an inching down of that backlog. So I thought that was the beginning of a trend, because we're working off extremely elevated levels. And so I thought that was the top of the backlog. When we started to see that come down, that was a very good thing to see, because it's really not that good to have backlog this high. It just means that production is simply not keeping up with demand. So with that, inching down of the backlog, I thought that, manufacturers and producers were finally working through the challenges that they had to go through because of the COVID disruption and numerous other reasons. And we would see production finally ramp back up and to be able to finally work down that backlog. But then as soon as, August came, we saw at the end of the month of August, we saw that backlog simply pick right back up. And you can see that at the very tail end of this chart, you can see that, uptick in backlog once again. So we'll see where this goes, but I really thought that would be working its way down, but it really didn't. So I think we're going to see at least another month or two, maybe more, of an elevated CPI, because again, if producers are not able to keep up with demand, prices have to rise, right? That's the natural law of prices, of inflation. When demand is outpacing supply, prices rise. Or if demand is simply back to where it is originally, but manufacturing productive capacity is still at a lower level, then also you would see prices rise. So either of those two cases, either of those two scenarios will lead to a high CPI. And so since we're seeing backlog really not moving much since June, it's down a little bit, but really not enough to make a dent into CPI. I think that this is going to continue for some time. So again, what's causing some of that, right? And we can see, sort of the anecdotal reasons for that. And here I pasted a snapshot of Automotive News, which is one of the leading news services concerning the automotive industry. And it's saying here that customers are losing patience as the chip crisis shows no signs of letting up. And here is a quote from that article from Automotive News: "Customer frustration likely to worsen this month," meaning the month of September, as shuttered plants and slowing production lines prevent dealerships from being able to restock. So that kind of goes into that same exact narrative that we saw in the previous slide, where production is so hampered right now because of supply chain bottlenecks that we're seeing inventories being drawn down, and production is really not keeping up with demand here. So what's causing this, right? So what's that leading to, right? What is causing this semiconductor chip shortage, right? And here I've just summarized some bullet points as to why this is happening, right? Because of the global shutdowns of last year, we led to production freezes. We saw a drawdown of inventories. And auto giants, remember, manufacturing companies really have to be very, very nimble on their feet because of the potential for massive losses during deep recessions. They have to be very quick and agile into making executive decisions as to what levels of productive capacity or capacity utilization they need to be operating at in order to protect the bottom line. Because if a recession hits, manufacturers really have to be quick at shutting down production so that they, limit the losses, right? The earnings per share losses during deep recessions. So as COVID started last year, auto manufacturers and chip makers made an executive decision quick. This is looking really bad. The global, GDP is going to take a big hit. It's going to take a while for us to, bounce back from this. Let's, flip the switch. We're shutting down production. We're preparing ourselves for a much lower level of output for the foreseeable future. And what that did is that they dramatically underestimated demand, because as soon as the lockdowns were ended and as soon as the vaccine was back on, by early this year, we saw a snapback in the economy, the likes of which we haven't seen. This was the shortest recession according to the BLS, or the Bureau of Economic Analysis, the BEA. And so, all of these producers dramatically underestimated how long this recession would take. So the exact opposite happened. Demand resurfaced very, very quick. And remember, it's not easy to just flip a switch back on, right? You can't just flip that switch back on, expect all your workers to come right back to where they left off and everything to pick up right where it left off. Manufacturing is tricky. You have to get each and every one of your suppliers back online. They themselves have to get their workers back online. And it's a lot easier said than done. And so, coming back online, to production capacity as it was back in 2019 takes a while, and it simply hasn't been able to, do so, thus far. And also silicon, right, which goes into manufacturing these chips. A big demand of silicon is coming now from COVID-19 vaccine manufacturing, because it's the same material used to make the capsules or to make the actual vaccines themselves. So, silicon is now being redirected towards vaccine manufacturing. And so now, auto manufacturer or chip manufacturers are fighting with, Pfizer, Moderna, and others, J&J, for demand for silicon. And there's only a fixed amount of silicon right now. So again, these are all reasons why prices have soared, and semiconductor chip manufacturing has really faltered. Again, production constrained. These are nearly identical reasons why lumber prices soared earlier this year. And I predicted at that time in June that, this, soaring prices of lumber would come down dramatically. And that's the part that I think I was actually right on. Since June, lumber prices have come down 50%, because unlike the semiconductor market, lumber manufacturers, sawmill manufacturers have actually been able to ramp up production a little bit. Their capacity utilization has come up. And so that's why the price of lumber has actually come down dramatically by 50% or so. Still slightly elevated from, where it was prior to COVID, but at least it's back within that range. So again, we can see here that, new car sales have plunged, now 13% down 13% year over year. However, we do see a glimmer of hope here, where the used car price index has actually shown the first monthly decline in over a year. Keep in mind, the used car price index is a big component of CPI. That was one of the big contributors to this shock report that we saw back in June, or really back in May, and then accelerating in June. So used car prices have soared because of the fact that auto manufacturers have not been able to ramp up production, and so dealer inventories are very, very low right now, and and that's causing extremely rising prices in the used car market. But this indicator right here, which is published by Manheim in conjunction with Cox Automotive here, I have a screenshot of that here. You can see how much used car prices have soared. This is a big, big contributor to why we've seen such a rapid rise in the CPI index. But for the first time in over a year, we have seen a drop off in that used car market. So is this a sign of buyer fatigue? Possibly. I'm not sure yet. It's still early. We're still very, very high up here, but this is an indicator to be watching very closely here. If this continues to come down, that's going to be a very, that's going to be very beneficial to the used car market, as well as the CPI is going to come down, or at least has, it won't be so inflationary for the CPI going forward. So this is something to keep an eye on. It's still early to call whether this is a top or not, but this is coming down now, so that's definitely good to see, in terms of, hoping for and anticipating a lower CPI number. So more components of the CPI are showing rising inflation, but not all. So it is lumpy. You can see that education prices are not up. This is a component of the CPI. It's, up 1% year over year. That's not a lot. So again, we are seeing more components of the CPI index rising. And so that's why the overall CPI index is up a lot. But not all components within the CPI are showing equal inflation across the board. So education prices are basically flat, and that's coming down, it looks like. Medical care is actually down a lot. We saw that rise up, in the early part of 2020, right when, COVID started, when there was a huge surge in need for medical care. That has actually come down dramatically here from 5% year over year down to essentially flat, year over year. So the growth rate of that has really come down pretty dramatically here. But other parts of the CPI have actually ramped up since our webinar in June. We see a rise in food and beverage prices. That's obviously critical for, especially the middle class. That's up 3.33%. Housing has really come up a lot. So that's attributable to just, housing being snapped up. We see that coming from, indicators coming from Zillow and Redfin, who are all reporting that. But I think, as of the latest numbers, we are seeing signs that there is a little bit of buyer fatigue at these really elevated prices here. So we'll see what happens to demand at these levels that we're seeing with housing prices. But compared to June, more components of the CPI have risen, so there is a broadening base of the CPI, and that's causing some concern as well. But again, not all portions of the CPI are showing, inflation across the board, as we can see here. And perhaps the most important commodity of all, right? WTI crude oil. Um, it still remains in a secular downtrend despite the year-to-date surge, right? Oil prices are up a lot this year. That's causing headlines, and everybody likes to look at that year-over-year percent change. And because it's such a high number, everybody gets freaked out. But if you look at the broader picture, I see a secular downtrend in the price of crude oil. I think part of that is attributable to a rising share of renewable energy relative to total energy demand, and the rise of electric vehicles, I think, and that's catching on as well. We're seeing a rising share of EVs, still very small at about 2%, but I think that number is rising. So with that will come a reduction in demand for oil, because of the fact that EVs are, gaining market share, and EVs are just generally more efficient than gasoline-powered cars. If you look at that miles per gallon, equivalent, you can see that there. So even if you were to charge your electric car with a gas generator, which would be ridiculous, but even if you did that, you would still be getting, almost 3 to 4 times the efficiency, because electric vehicles on a miles per gallon equivalent are 3 to 4 times more efficient than even the most efficient, hybrids that you can see out there. So I see that, crude oil is remaining in a secular downtrend despite that huge, year-to-date surge there. So we'll see what happens here, but I still don't think that this is cause, for concern with regards to, commodity inflation. And wages have actually kept up with inflation. You can see that. I used ZRS to look at wages or salaries relative to the price of oil. So you can see that, interestingly enough. And that has actually remained stable over the past 4 years. So this is one of the things you can do that's unique within the Zacks research system, ZRS, is look at different economic indicators relative to one another. So I looked at wages and wage growth relative to the price of oil, because again, oil is such a critical input to the economy. It affects everyday Americans, from the rich to the poor. Everyone equally relies on WTI crude, at least for now, until electric vehicles really take over. But right now, it's still a very small share of that. So you can see here that wages have actually grown in conjunction, in lockstep with the price of oil. And really, over the past 10 years, wages have actually outpaced the inflation of, or the price of oil, the growth in the price of oil, partially because, in the last 10 years, as I just showed, the price of oil has actually come down pretty, steadily here. So even with that huge volatility in between, we do remain in a secular downward sloping channel. And over that same time period, wages have consistently risen. We do see this huge volatility, but overall, from the depths of the recession and really even the early stages of the recovery, since 2014 even, the middle class, and really all Americans, but especially the middle class, have actually been in a better position now than they were even as recently as 2014, because you can see that wages are now, basically what it's telling you is that your wage, the average wage, is able to purchase more gas at the tank than they used to back in 2014. So that's also a good trend to see here, that wages have actually outpaced the growth in the price of oil. So what does this mean for equities, right? We're all equity managers. This is the most important question for us. What do we do with all this information? Why does that matter to us? Well, we can see here that if we look at GDP, just nominal GDP growth, check out what this chart is showing you here. This is another example of a chart that you can build within ZRS and Advisor Tools. The top panel here is showing us the nominal GDP level. And you can see here that, that what happened during COVID, we had that sharp drop off, that recession. But look what's happened since then. We're actually right back. If we were to draw this straight trend line here, we're actually right back to where we would always have been had COVID not even happened. So if we were to draw a straight trend line, we're right back to where, GDP would be, if there was, if nothing really happened. right? So we're back to trend GDP, but check out what's happening to the labor force. This is the size of the labor force here. We were at 158 million workers in the labor force right before the pandemic hit. That dropped all the way down to below 136 million. It's actually down to about 130 million almost. So that was a loss of, nearly 28 million workers from the workforce. We've recovered that, quite a bit here, but you can see here that we're still off from the all-time highs. We were at 158 million at the highs, and currently we're about 153 million right now. So we're still 5 million workers short from the all-time highs. And yet we're actually back at trend and really at, higher levels of GDP. So what does that mean? We're at higher levels of GDP from the 2019 highs on 5 million fewer workers. That means that productivity has soared. And that's why, what do we see here on the bottom panel? This is the net margin for the S&P 500. Net profit margins are now at all-time highs. We haven't seen this happen in over 25 years. We're at 18% on a weighted average for the S&P 500 net profit margins. This is the reason why the market is so strong. We see productivity gains unlike, what we've ever seen, before, right? Higher levels of GDP output on fewer workers, 5 million fewer workers. What's that leading to? Profit margins at all-time highs here, 18%. This in one chart is the reason why we've seen such resilience in the S&P 500 index. And I just don't see this, letting up anytime soon. Gross margins for industrials. This is another thing to look at. So we want to look at, what portions of the market are doing this. Because let's say, the S&P is just dominated by Apple, Microsoft, Amazon, Google, right? So what if this is just, tech stocks, doing this? And yes, that's true. It is mostly tech stocks, but if we were to isolate this, we can see here that gross margins for industrials have also been never higher. So this is using the Zacks Standard Industrial Proxy. This is a component of the S&P 500 that removes all of the cyclical, companies here. And so those gross margins are at all-time highs as well. So we can see here that even if we do see rising inflation, either companies have been able to pass on those costs to their customers, or some companies are choosing to absorb those higher levels of, input costs. Either way, we're seeing gross margins really at all-time highs for industrial companies. And then cash flow margins are also at all-time highs. We want to make sure this happens as well. Because remember, net margins are great, right, from a profit, point of view. But we also want to see confirmation coming from cash flow, because cash flow is what really matters. We want to make sure that companies are not, generating much of that profit due to accounting gimmickry or, relying too much on accrual accounting. So cash flow removes that bias here, and we see that cash flow margins are also at all-time highs, again, at 24%. This is a level of efficiency that we've just never seen for the S&P 500, really in recent memory, or even in the past, 20 years or so. Also, Chicago PMI shares a 64% correlation with S&P earnings. So again, this indicates to me that there is further earnings per share growth that could be, coming in the latter half of this year. We see here, check this out. We can see how well it correlates to one another. Chicago PMI, which measures, the production capacity of Midwest, manufacturers, Midwestern United States. You can see here that, that PMI level remains elevated. As long as it's above 50, it means that we're in an expansionary state. And it's currently at 68 or 66, off of the very highs here. But again, that's partially due to the very, depressed lows that we saw, in the early part of 2020. But as we move into the second half of 2021, as long as it stays above, 50, really even 60, that means that we're still in expansion mode, and we're going to see the S&P earnings come in at very high levels of growth year over year. So I would keep an eye on the Chicago PMI, but it looks like this is going to, continue at least through the end of this year. Also, again, despite persistent inflation that we're seeing from the CPI, right? 30-year bond yields still remain in a downward, trending channel. We did see, 30-year bonds, rally from that all-time low that we saw set. But again, we don't see a whole lot here. It's still setting higher or lower lows and lower highs as well. So that, rally that we saw in yields earlier this year are still, in my view, not very relevant. And now we're seeing yields once again resume that downtrend. So again, if inflation is really a threat in terms of being persistent and due to uncontrollable factors, such as excess liquidity that can't be controlled due to Fed monetary policy, I think that the long bond would start to show that, and we see both the 30-year and the 10-year really showing absolutely no signs of concern. So the bond market, in my view, is telling me, and keep in mind, nominal interest rates are driven by inflation. So if there was an expectation of permanently higher inflation due to factors that are simply uncontrollable, then you would start to see significantly higher interest rates at this point. But we just don't see any evidence of that yet in the bond market. So as long as this continues in this downtrend, I personally think that, the low is in for, bond yields, unless if we do slip into a recession again. But, even if we see a sideways trend in the yield, which is, I think, what's going to happen now. Again, that's not very indicative of the bond market anticipating, uncontrollable inflation, seeping into the system. So again, we see high levels of CPI. I think that's going to persist again because of backlog concerns, because of production capacity concerns, but we don't see this number, coming up. We don't see interest rates rising in a dramatic fashion in any way. And that to me is the greatest indication that the bond market does not believe that this inflation that we are seeing, and there is inflation, no doubt, but the bond market is saying, in my view, that's my interpretation of this, that this high level of, these high level of prices are not attributable to factors that are outside of our control, right? These high levels of prices are within our control, and it's due to, production constraints. If we resolve those production constraints, we will see that CPI number come down. And that's, I think, what the bond market is conveying. Again, if you look at spreads here, the 10 to 30 spread, we see that the spreads have increased, but they remain subdued. Keep in mind, the spread always narrows right before a recession hits, and the spreads have been a remarkable forward-looking indicator for recessions. And we see that, in almost every recession dating back to the 70s here, we see that the spread has really tightened right before that happened. And so we see that spread, hitting lows here right before the recessions of the late 70s, during that hyperinflationary period. We saw the spread narrow right before the recession hit in 1990. Again, right before the dot-com bust, right before the Great Recession, and again, right before the COVID recession. We're seeing that spread narrow a little bit now, but again, it doesn't look like it's hitting a low just yet, and we're kind of still in that reflation mode right now. So again, we don't really see too much coming out of the coming out of interest rate spreads here either. So again, if the point here is that if inflation were truly persistent beyond production woes, attributable to deeper and more concerning reasons, such as like what many people are talking about now, dollar debasement, by the Fed's QE actions, I don't believe, again, that the long bond would be, this low for this long. Okay. So that's the key point to drive home here. If this inflation that we are seeing throughout the system were truly outside of control, then Treasury yields would be substantially higher, in my view. And spreads would also be much, much higher as well. Because keep in mind, the 30-year bond has much greater duration risk than the 10-year bond or even the 1-year bond, the 1-year, 1-year paper. So we should be seeing increasing nominal rates as well as increasing spreads if that were the case. But we haven't seen that just yet. So again, I think the bond market is telling you that whatever inflation that we are seeing is, due to shorter term, maybe medium term, production woes. And really, lumber is the model for what could happen if production is ratcheted back up, right? You might say, well, hey, Mayur, like, what's the evidence here? What's the evidence that, production coming back up is the solution to everything? Well, we can use lumber as, example number one. It's exhibit A of what happens when production is severely hampered, and then what happens when production comes back up. And we saw, right during, the early part of 2021, lumber really soared dramatically. It basically, almost, 2x or 2.5x from, that low that we saw in 2020 here. It got down to about $435 on the futures market, all the way up to 1,600. So that's almost a 4x, right? A little bit less than 4x. But that was due to sawmill capacity utilization getting hit dramatically. And I talked about that in the webinar from June, that, we see anecdotal evidence from companies that are directly involved in lumber production saying that they're simply not capable or not able to just ratchet up production because of a severe lack of getting the labor force back on, as well as other factors too. Like during that time, former President Trump had put on import duties on Canadian lumber during that whole time that there was some negotiation going on with import duties there with Canada. That also contributed to lumber producers not being able to ratchet up supply again. But again, also mostly due to the COVID disruption, lumber producers were, operating at well below capacity utilization. And look what happened as soon as they got back up. We see lumber, collapsing in an epic fashion. It did bounce back up a little bit from that low here at 495. But again, I think that's I think it's a technical bounce. I see lumber coming back down as long as, sawmill producers, as long as sawmills are able to ratchet back up their capacity utilization. And we saw that happen in grand fashion here. So in my view, this is a model for what could happen to goods and services inflation, what could happen to commodities inflation, what could happen to auto prices, especially auto prices, used cars as well as new cars, if production is able to come back online in a level that meets where demand is right now. So if lumber can do it, I think other parts of the economy that's seeing, rampant inflation can also do it as well. And again, if we look at the ISM, the latest press release from ISM on the manufacturing PMI, we see it's still expanding at a decent rate. It did come down to about just under 60%. However, you can see some of that anecdotal evidence here from the commentary. You can see that they're saying that the backlog has still been growing despite increasing production. That means that even with higher production, demand has actually increased at an even faster rate, and so that leads to a greater backlog. Raw materials inventories are growing, which is a good thing, right, for production. But customer inventories are still too low. So that's what we're seeing here from the ISM. And if we read into that press release, I highlighted some of the key takeaways here. That the surveys that they're generating from producers and panelists here from their survey, they're saying that suppliers continue to struggle at unprecedented levels to meet increasing demand. right? So all segments of the manufacturing economy are impacted by record long raw materials lead times, continued shortages of critical basic materials, difficulties in transporting products, worker absenteeism, short-term shutdowns due to part shortages, difficulties in filling open positions, and overseas supply chain problems. Again, this is all production-related issues here that we're seeing. This is not, excess liquidity that's, causing this to happen. This is not, QE. This is not, excessive Fed balance sheet, that's causing rising prices. In my view, again, this is actual, this is a real inability for, producers to be able to meet, to meet demand because of shortages, because of difficulty in filling positions, because of supply chain issues, because of other disruptions that have occurred, because of the lockdowns. This is far greater than what we ever thought was the case, and this is persisting for longer. So as long as supply chain disruptions continue, then producers are going to continue to have difficulty in meeting demand. But again, that is an important why, right? The underlying why as to why inflation is up. It's not due to excess liquidity, again, in my view. It's due to a genuine inability for manufacturing to keep up with demand. So that, in my view, if there's ever a good problem to have, this is it. This is a good problem to have. It's still a problem because, companies are simply not capable of, producing enough. And that's actually putting a lid on revenue growth as well as putting a lid on earnings growth. But it's still a good problem to have because the demand is there. Demand is there, but, production is still constrained here from where it was prior to COVID. So again, it's a good problem to have in my view. So again, common underlying theme that we're seeing here throughout all these press releases and other, data points, supply disruption is the key culprit behind the majority of the price inflation that we have seen. And again, if you look at from a monetary point of view, M2 money velocity still remains at record lows here. This needs to pick up in a dramatic way if we were to see inflation attributable to monetary concerns being the primary culprit behind rising prices. So in summary, the key findings that I see here, again, we're seeing anecdotal evidence and empirical data that supports this view that it's significant production setbacks by manufacturers that's causing this inflation. The case study here is lumber production. Lumber, soared, because of that huge backlog. Now that sawmills are back up and online, we see lumber prices coming down. I think that's the case study of what could happen to other, parts of the economy if production capacity were to come back up. I was wrong in the June webinar as to how long this is going to take. I think it's going to take much longer. It could persist well into 2022. So maybe we're going to see several quarters more of a CPI reading in excess of 5%. But I would keep an eye on that backlog. If that backlog does come down, we will see that CPI come down. But if backlog remains elevated, then we're going to see that CPI number stay high. So the key point to watch here is that backlog, business inventories, production and demand indexes. We want to keep an eye on the manufacturing PMI, factory orders, new orders for durable goods. These are all the demand side of the equation. So as long as demand remains healthy, then whatever backlog, whatever inflation that we see is due to a genuine inability for production to meet that demand and not due to other concerns coming from Fed-induced inflation as well. So for all these reasons, I think prices will prove to be transitory. I know it's a sort of a bad word these days because the Fed keeps using it. I hate to just be a parrot of the Fed. I really don't mean to do that. I'm very critical of what the Fed has done. I think the Fed balance sheet has remained elevated for way too long. I think the Fed is being way too timid on tapering their asset purchases because as of right now, I don't see any evidence or any reason whatsoever for the Fed to continue keeping their balance sheet so large. We've seen a strong recovery in just about every economic gauge that we can think of across the board. Prices have come back up in a dramatic fashion, as we've all seen. So there's really no reason why the Fed should continue to delay tapering. I think it should be happening sooner rather than later. And maybe even interest rate hikes are, warranted. Maybe not by much, but a little bit. I think it should be the case. So the fact that the Fed is very, very slow at, tapering that emergency response, I think is going to be more damaging than helping. But we'll see. I think again, the key focus here, in my view, is not the Fed, but really its production capacity. So I hope this was helpful. Thank you again for attending, and we'll just take a look at some of the questions here that we have seen. Again, if you do have any questions, please do ask that in the webinar panel here. So the first question that we see is, let me try to break this out here. Are we starting to see wage inflation at this point? Isn't that a sign that inflation is more permanent than transitory? Yes, we are seeing wage inflation, but keep in mind, it's happening on fewer workers, as we saw. So even if we do see rising wages, because the overall economy is employing fewer people, I think that companies are able to absorb that higher wages, right? And there is sort of a competition right now. Workers are in demand, right? Companies are showing, we see a record high JOLTS number. We see very, very high job openings, and a lot of those positions are simply not able to be filled right now, and so that's leading to rising in wage inflation. But because we still have 5 million fewer workers and GDP has recovered back to, the all-time highs and into new highs, we're seeing revenues, back up for the S&P 500 and fewer workers employed in achieving those revenues, right? So overall, that's why we see margins so high. So even with wage inflation, because of the fact that S&P net margins and operating margins and cash flow margins and even gross margins, because they're all up, the wage inflation is really not weighing on the markets right now. The wage inflation is happening, but it's not weighing on the markets because margins are still up. So that's what we have to keep an eye on is the margin at that point. So I wouldn't fear wage inflation, as much. So with that, if there are any other questions, let me see here. Oh yeah, there are plenty of other questions. Another question: you had a big run up in housing prices, but is that the figure for housing component of CPI is a fake housing rent cost figure, not real housing prices? When does that rent figure start accelerating? Yeah, that's a good point. Rents were actually artificially low for a time because of rent control that we saw in many municipalities. We saw many municipalities restrict or even ban evictions, right? So rents remained low for a while, and that was artificial because it was mandated by local governments. Rents are not coming up dramatically again. So that is also a portion of why housing prices are coming up. Because if rents are coming up, then relative to renting, owning becomes more attractive. And so some dollars start to chase ownership, as well as investors. They see that rents are up, and so they'd rather own in order to rent out as an investment property. So it's kind of this epic, tug of war, or maybe a game of hide and seek, or a game of cat and mouse here, with rents rising dramatically now. as more municipalities start to lift those rent control measures. And so that's what's happening now with housing prices. So again, I do see that rent prices are coming up, alongside housing prices. Another question is, why do you think that there is an increase in food and beverage CPI increase? I think that food and beverage prices are coming up again because overall inflation is coming up. Remember, the macroeconomy is so interconnected here, and technology is at the center of it all. But one thing leads to another. Every item that's produced for the consumer economy has multiple supply chains involved before it gets to the end customer. And if suppliers are unable to, keep up with your orders, then remember, in this, in the process of manufacturing, you can only move as fast as the slowest supplier is able to keep up with your orders. So if there's even one supplier within your supply chain that's not able to keep up with your demand for producing, food and beverage, then you're forced to reduce or slow your production. So again, since we see rising inflation in other parts of the economy, that ends up spilling over into other parts of the CPI as well. So that's why we saw back in June, there was only 3 out of the 11 components that we saw, or I can't recall exactly how many total components there are. I think it's about 10 components to CPI, but we only saw 3 out of those components seeing significant inflation. Now we see much more. Now we see about 7 or 8 components out of the CPI, out of the categories of the CPI seeing inflation. So when one component starts to see inflation, that starts to spill over into other components, and it's kind of this domino effect that we see here, because every company, every end product has multiple suppliers, and if one supplier is still not able to keep up, then that spills over into other parts of the system as well. So that's why I think we are seeing food and beverage inflation as well. Another question, the uncontrollable function of inflation is U.S. debt to GDP that nominal yields still have to wake up to. That's true as well. Yeah, I mean, I wouldn't disagree with that. There's very, very high levels of debt to GDP. However, if you believe in some of the estimates, the forecasts are that debt to GDP is forecast to come down because some of the spending that occurred, in response to COVID, some of the emergency, safety net spending is projected to ease over the next couple of years. And so I believe if you look at the estimates from the Fed, if you believe that, are projected to show that the deficit relative to GDP is coming down in 2022 and beyond. Again, that's assuming that COVID doesn't continue to cause disruptions to the economy or other sources of recession. All great questions. Another question: inflation is debt to GDP, growing through QE and fiscal spending. Yes. Again, yes. I think a lot of that is due to government spending. It's due to deficit spending. So if some of that comes down, right, because of a waning sort of safety net, when the economy comes back from COVID, then I think that would have a little bit of a tapering effect on inflation. So if we do believe the Fed's projections as to what deficit spending is going to look like in the coming years, then deficits as a percentage of GDP should be coming down. If that comes down, that's going to have a sort of bearish effect on the CPI, meaning that should be negative for CPI and therefore good for the economy overall, or good for consumers, that is. Another question: will real estate prices continue to rise, flatten, or pull back? So that's hard. I think we are seeing a little bit of that. We are seeing from Zillow, I believe, and Redfin both, who publish data on housing prices. We are seeing a little bit of a cooling effect on housing prices, so maybe there is some buyer fatigue at these really high levels of prices that we've seen. So maybe at some point there will be buyer fatigue, and buyers will be back in vogue again. It could become a buyer's market. Right now it's been a seller's market all throughout. So I do think that housing prices should flatten. We are seeing DR Horton, Lennar, and other home builders accelerating their their construction efforts. So building permits are up. So I think supply should be coming back on. So again, it's another function of supply and production. If home builders can operate at high levels of production, then we will see supply come back up and meet demand, and that would then cause housing inflation to then come down. So again, I think all of this, the key factor here is production. Another question we have is impact of end of foreclosure moratorium in 4Q 2021 and the first quarter of 2022. I don't have a strong opinion of that. With regards to the end of the foreclosure moratorium, if anything, that would help. Reduce prices, I think. But I don't have a strong opinion of what that might do. Again, the key to prices in housing is going to be production. If Lennar, if DR Horton, if Pulte, if all the other home builders are able to operate at higher levels of production, if they don't have any supply chain constraints, and maybe there might be some buyer fatigue as well at these high prices, then that will all have a cooling effect on housing inflation. So perhaps the end of foreclosure moratoriums would also continue to have a cooling effect on housing prices as well. I think so. What do you think we should? Another question is, what do you think we would see deflationary disruption happening? Yeah, I think that's going to happen. I think that's in the middle of happening right now. We see multiple industries offer deflationary pressures. Like, for example, in medical care, right? That was one of the sectors of the CPI that's been very low in their inflation, and part of that is due to medical technology. We see the rise of companies like Teladoc, which are helping control costs in medical care because it just makes a lot of sense. Telehealth just makes a lot of sense. It saves costs, it saves time, it increases productivity per hour of doctors, right? Of primary care physicians. They can see more patients in fewer time. That increases the productivity of primary care physicians. It just saves a lot of time and a lot of money. So that could be one reason why healthcare costs are down. And that's going to happen, I think, in other sectors of the economy. I think as electric vehicles start to take bigger and bigger share, I think fewer people will even care about what the cost of gasoline is going to be. And I think there's going to be over 1 million Americans over the next year and a half are going to go off grid and have electric cars that are charged by solar on their roofs. So again, all of this is causing a deflationary pressure, again, because of technology. And so we see this happening throughout industry. So again, as disruptive technology takes hold, that's going to cause another sort of long-term lid on inflation. And that's also another reason why I think bond yields have remained low for all this time. So I hope you guys, that's the end of all the questions here. I hope everybody found this helpful. If you do have any questions, please email us at ZRS@Zacks.com if you are a ZRS client. If you're an Advisor Tool client, please send us an email at ZAT@Zacks.com. And you can follow us on Twitter at ZATools. You can also follow me as well on my Twitter, as well as on my LinkedIn. You can see my info up here at the top here. And yeah, I hope this was helpful, and this will be replayed on our YouTube channel as well. So please check out our YouTube channel. You can just search Zacks Pro, and you will see all of our videos here posted as well. Thanks everyone, and hope to see you on the next one as well. Take care, everyone. Bye.